Hey everyone, this is Dimitri Pergamonic with MarketChameleon.com. I wanted to build upon our previous example using the credit put spread screener and talk about a downside cushion and how to set a downside cushion. So the idea behind a downside cushion is when you're selling credit put spreads, you could have a credit put spread that's in the money, out of the money, or at the money. And when you have a downside cushion, you're really talking about put spreads that are out of the money, which both strikes are basically below the current stock price, and you have a little bit of cushion if the stock reverses course and goes against you directionally. And I'll talk about that a little bit more in this example. The first thing I do, though, before I even start it, before I'm going to show you that screen, is I like to screen for positive theoretical edge credit spreads to narrow down. And what I mean by that is we're looking for credit spreads where the market price is above a theoretical value. I set it at least 10% because we want to sell it above a theoretical value, knowing we're getting a pretty good deal. Also, I set the theoretical win rate above 60%, looking at the historical data for this spread to be profitable at least 60% of the time or more. Now, once I set that, also, let's just set this to any expiration that expires within the next 30 days. So this will give us all the different expirations as long as it's within 30 day expires within 30 days. So this downside cushion here, let's just set it right now across the board. So I'm going to put in a universal at least 1%. So this is going to change. This changes all the items in our screen right now, and over here you see 1.1%, and what this means is we could take a look at Microsoft here. Right now the stock's at $133.35. You're selling the 133 put in July 19th and buying the 130 put, so you could see that this put here, the 133 put, is below the 133.35 stock price. In other words, if the stock price just sits here or goes higher, but even just sits here at expiration July 19th, this would be a 56% return on your risk. So that you're selling it for $1.08. This is a $3 put spread. Your risk is $1.92. So if you keep that $1.08 and your risk $1.92, that's a 56% return in the next, 14 trading days. And this is the study of the theoretical value. So one of the things you can set at least a 1% cushion, at least a 1% cushion, 2% cushion from here, and this will give you for any stocks in here. Right now it's sorted by market cap, but you could just resort that, and all the items in there will be at least 1%. But every stock is a little bit different, so there's a different way that we could potentially set a downside cushion. 1% down move in Microsoft isn't the same thing as in maybe a different stock that is very volatile and moves around a lot. And let's just look at our statistics over here, and I'm going to look at the historical price return distribution. And what this does is it runs an analysis for the number of holding days you have from now till expiration. So you see till July 12th, there's a 9-day hold period. For this credit spread, this one expires July 19th, so that's a 14-day holding period, 14 trading days to go, and so on. And what it does is it goes historically, and let me just see for how many years. Right now it's doing it 4 years. Let's set that to 6 years. So it's going to look in the last 6 years. It's going to look for this stock, for example, an AMD 19-day hold period, right? It has 79 observations. So if you for 19-day hold period from day one, held it to 19 days, what were the returns like? And over here it says 50.6% of the time the returns were positive, 48.1% they were negative. The average move was 3.5% of all these observations. The median move, the moves in the middle, was 0.6%. The average up move was 15.2%, and the average of all the down moves was negative 8.7%. And this is what we're really looking at. If we're concerned about a downside protection, maybe we don't feel as confident. Maybe you're thinking these spreads look pretty good. You know, the returns look pretty good, but I'm not very confident that in the direction right now, and I need a little bit of extra cushion. So you could set that and say, I still, even if, and what we're going to do is say the following: even if the stock in this situation moves down negative 0.8.7%, AMD, find me spreads where I at least break even or am profitable. And this is over here, payoffs at expiration. What I'm going to do here, if average down moves. So what this is saying is, at expiration, if the stock is down at expiration, you know, from today, by its average down move, over here, by its average down move, I'm going to set this. I want my return on my credit spread to be any positive. You could pick one of these, but let's just say any positive. So this is going to change all from the screener. If average down move, I want my credit spread to still return something positive. I still want to make money. So here it is. So here, this is the average down move, negative 2.8%. Let's come back to the summary here. So there's your cushion, 2.8%. So it's at least that. All right. Let's take a look here. Over here, 4.5%. So here's our downside cushion, 4.9%. As you can see, the stock is 27.60, right? It's above the 27 price, and we also get 75 cents credit, so that's a 4.9% cushion to break even. It could still fall below 27, right? You could still fall below 27 by 75 cents to 26 and a quarter for us to break even before we start losing money. And that's how you could use the average down move to set a downside cushion based on your historical statistics. Another thing you might want to do, and I'm just going to go right here, strategy payoffs. And this is basically your payoffs on your credit spread based on where it lands. And sometimes, you know, you might be very, you know, maybe even more conservative and say, well, if the stock drops by 1 standard deviation, I still want to be positive, right? So I still want to make money or break even. So right here, if the down move is at least once, if at expiration the stock moves down by 1 standard deviation, I want to be any positive. And then this will, so over here in this QQQ, right, let's just take a look. If the QQQ is down by 1 standard deviation, right now it's 186.34, you're selling the 181, 176 put spread. So you can see there's a lot of cushion there, about $5. So even if the stock drops by 1 standard deviation, your credit put spread will still return a 3.1% return. And that's over here. If it just sits here or goes higher, that's a 16.6% return on your risk. And let's just see, you know, with 9 trading days to go. So that's how you would use the downside cushion to set either on an average historical down move using those statistics, or a 1 standard deviation down move. Thanks for watching, guys. See you next video.